Today, I wanted to talk about pricing out loans. And there's going to be a couple platforms I'm going to show. So the way our company works is once you guys can all see this, right? You can see my screen. Yeah. Once you start to get more applications coming in, we get you access to a system called Arrive. But if you're newer, it's better to start with UWM, and there's a lot of reasons why. I want you all to make a habit of reaching out to Charlie, our account executive with UWM, because there's new things. Like, he sees the rates all the time. He sees the products all the time. Some days, you might save the client 0.5%. I know people want to talk basis points all the time, but 0.5%, you're going from 6.5 or 7 to 6.5 by advertising a 7-1 arm or 7-6 arm, which is locked in for 7 years. Most people are going to refinance or sell before then, before it has time to adjust. But it's good to make a habit of presenting that, but also getting familiar with one system at a time. As you start to get more loans and more applications, that's where the system tends to be just a little easier to work with. So when people are working with the system, the thing that I like to say is, as you price things out with this particular system, you have to do one thing at a time. So I always say, give multiple options. Even though it's clear as day, someone should go with a conventional loan or they should go FHA. You never know what your competition or some random person may present to them that wins them over, or now they're questioning you. And that has happened to me many times. And so you just always want to present multiple options. Plus, people just like the idea that you're presenting more options. So it's always important to check as many different boxes as you can. A lot of systems will automatically, this is a big one, these two right here, reserves. So monthly payments that are kept in reserves, a lot of times people will put a specific amount there, or they'll put 24 months, 12 months, because the system will automatically put that. Why? I don't know. I think Arrive finally changed it so it's not doing that, but you may have a borrower who puts something in the application that triggers it to say that. Some of them will automatically check that they're a first-time home buyer. Arrive sometimes has technical issues, so that can make a big difference. Obviously, non-owner or non-occupant co-borrower makes a difference. Self-employed, not really. But you just want to make sure that, if they do have 12 months worth of reserves. So someone says to you, and this is why the initial call is very important versus just reviewing an application. Because if they say to you, I've got 100,000 in the bank, but here's the thing is I only want to spend 30,000 out of pocket. I don't want to spend all of my money. Or they say, well, I have money in a 401k, but I'd rather just use what I have in my savings. Great, no problem. But I can get you better pricing. Even though you would never pull money from the 401k, it looks better on file or, on paper, because it shows that if in a pinch, in an emergency, you had to pull from that, you could, because you technically can. But it will get you a better interest rate. So it's important to put that or not put that, because you don't want to price something out and say, oh yeah, we can give you this loan. However, you can't because you put 12 months or 24 months and they don't have 24 months of reserves. So now you're quoting them a totally different interest rate. But with the interest rate and with Arrive, I just want to show this real quick. If I'm showing different examples, I must have selected adjustable rate. I have to select one, and then I go back here, and then I reselect another. It's because I did adjustable rate. So I would select this, and then I would do compare. It does this, it has a document, but here's the thing is I never want to send people this document. Same thing with UWM. When I'm pricing something out, it's actually a little bit easier, is I can choose multiple at the same time. I always have to put the zip code because it's going to pull AMI. So average sorry, not average. Basically the anyone watching this recording is laughing at me. It pulls the average income for the area based on usually the government agencies. So Fannie Mae, Freddie Mac, it's usually all the same thing. But it's within the median income for the area. That's why I'm forgetting what the A is. I think it's average median income, because you can get some better loan options if they're at or below 80%, or if they're at or below 100% of the area, AMI, area median income. I feel stupid now. But this is important too. So, right, you could put loan to value, you could put whatever. I try to put as much detail as I can. So first time home buyer, yes. Now they don't automatically put anything in this easy qualifier, but they do force you, so they make it a required thing to get pricing to put their income. So if I put 8, let's just make sure I put a decent amount. 10,000 monthly income. Now taxes and homeowners insurance is going to be a little different. So I know taxes in California, you can Google most of this or call Charlie. It's 1.25%. So this is going to be annual. So 6,250. Homeowners insurance has been a little wonky. I will do 0.2% and then go up a little bit. And I tell them, this came out to $1,000, but I'm going to put 1,200, although it could very well be 13, 14. And you could do lender paid, borrower paid. We can always look at that. Always in-house processing. The rest of the stuff, don't worry too much about, unless if you know that they have money in reserves. So then I click get quote. Oh, what field did I not complete? Oh, credit score. Credit score is huge too, because it can make a big difference. Let's just say 750. Now with Easy Qualifier, the way that I can price out is you can do, I think it's up to 3, maybe it's up to 4 side-by-side comparisons, whereas Arrive is a little more limited. I think they only do 3, whereas Easy Qualifier can do 4. So let's say I wanted to price this one out and show this as an option. Okay, here's all the different rates, but here's 6%. Oh, but it comes at a cost. The only thing I'd say is sometimes it puts the first one as the best one, but sometimes it doesn't, and I don't fully know why. So like this is not the best one because it's charging them a fee. So I would offer them one of these two. Obviously, I think this is a good one, but I would just select right here, mark for comparison. Go to the 5-1 arm. I'm going to select that. I'm going to click mark for comparison. Let's just offer them conventional. HUD REO means it's a HUD owned home. So, there was an FHA loan. They defaulted. HUD took over. So that's irrelevant. You don't look at that one. Once again, this is why you want to call Charlie to go over the options with everyone. Actually, rates are doing a little bit better today. And then we'll do conforming conventional. Let's see. Oh, no, you can only do 3 at a time. That's right. So then I come back up here to the comparison tool and I select this. Now, what you could do is you could download this as a document. It's probably what I'll do, or you can expand it, but I'm pretty sure I usually download it as a PDF and then I zoom in. So if I click this, save as a PDF, save. And then now it's a bigger screen, which is why I do it. Now, when I am quoting someone, so I had an initial call. I told them I'm going to put together some options, but I want them to complete their application and we'll talk over next steps. And if anyone wants to see an example of me doing this, I'd be more than happy to send you some links. Maybe I'll post about it. But I say, hey, John, it was great talking to you the other day. I just wanted to put a face to the voice and name. I figure that a lot of these videos tend to be easier for people to follow. Plus, you can go back and rewatch this, share this with your spouse, because I didn't get a chance to talk to Susie. But I just wanted to show you this. So I've been looking, and I know that you said you're looking around a $500,000 purchase price and that you want to put 20% down. So I want to show you 3 different options that seem to be the best, but I can always show you more if you're interested. It's that most of them are going to come with a higher monthly payment. So principal and interest, your monthly payments comprise of principal, interest, taxes, and homeowners insurance. Taxes are usually, they're always pretty much the same. Unless if you're in a very new construction area, which please talk to me if you are looking for homes that are built. And I only know that because of California. You don't have to mention that in your own videos. But homeowners insurance is something you can shop around. I like to overestimate a little bit, but once again, this is something that you can shop around as we get into contract on a house. I have a few recommendations I can send you. Obviously, we're in California, and homeowners insurance right now is a little weird. But you're looking at a monthly payment roughly, because don't forget, Mr. Borrower, Mr. Smith, John, that your payment does, the interest rates fluctuate multiple times in a day. So it looks like right now FHA is going to be your best bet as far as keeping your monthly payment lower. And so you're looking at $3,584 a month. And even though with alternatively, we have a 5/1 ARM, we have this, and I go into detail, but I focus on the payment. And I'll say, this payment over here on conventional might be a little higher. However, there's less going towards, or sorry, not 20% down. Sorry, I did 10% down. Some of the closing costs are a little bit less. So it's up to you if you'd rather have more coming out of pocket, or if you're okay with a slightly, if you want less out of pocket, but a slightly higher payment, we can go this route, or we can go with this one. Now, what I'd like you to do, John, is as you're looking at houses, obviously they're not all going to be exactly 500,000, but if interest rates fluctuate, I'd love for you to text me and say, hey, I'm interested in this house. Can you send me more updated numbers? Or you can talk to your agent, and if your agent says that they believe there's room to negotiate for a credit or a price reduction, which a credit is basically the seller is giving some of their equity to help cover closing costs, lower your interest rate, do a temporary rate buy down, whatever it might be. I'd love to talk with your agent about that so that I can, at that moment, look at where it's at and do a side-by-side comparison of, okay, what if we got a price reduction? Would that save you more, or would it be better to use some of that credit to lower the interest rate? That way, you know how to best negotiate. The reason why I say that to people, and if you heard, I did not mention the interest rate. They can see that if they want, but I want them to focus on the payment because it's too hard for people to equate anything else. I'm recording. We're in a meeting. I'll be right with you, okay? I'll come play with you in a sec. Sorry, my daughter's working here. You gonna stay with me? Just people can see you, okay? But this is how I do it. This is why you don't need to be super accurate in the initial interest rate, but I don't send them this document. If they ask, then sure, I'll send it, but I like to keep it like this. The problem is if you send a document, someone will take it to another lender and they'll just find a way to beat it. Even if rates just happen to drop the next day, so I send this today, everyone has lower rates tomorrow. They're just going to say, oh yeah, I have much better rates than that, because that's exactly what I would do. So never bring up the interest rate. It doesn't really matter. What matters is their monthly payment. Now, the reason why you want to have an initial call before sending them any of this or talking about any of this is you want to hear from them what they'd feel comfortable in a monthly payment. So if this person told me, I'm looking for no more than, if it's a perfect house, I'll go above it a little bit, but I want no more than $3,200 a month in my monthly payment. Then what I'm probably going to present to them is a lender paid or a seller paid temporary rate buy down. And I'm going to show them a whole different temporary rate buy down calculator, because I want them to feel comfortable that what I'm quoting them matches what they want. But I'll tell them, you can't have the seller pay for it if there's multiple offers. So let's say there's 3, 4 offers on the house. It's going to be hard to get a 1% credit from the seller to help lower your monthly payment, or a 2%. In that case, we can do something called a lender paid. It just means that the initial starting rate might be a little higher, just by a little bit, but at least you can enjoy that payment closer to your goal. And our plan will be to refinance you in 6 to 8 months after we close. Is that okay with you? And some people say, absolutely, as long as I can find a house that is move-in ready, then I'll go for a $500,000 purchase price. Otherwise, I'm going to aim for more like 475, so I keep my payment where I want it. Does that make sense to you both? Yeah. So, and I bring this up just because I want everyone to make sure that, anyone watching the recording as well, that we focus a little, we stop focusing so much on the interest rate and we really put emphasis on the payment. This is why I send the recording versus trying to get on a phone call with someone to go over this. Why? Because sometimes people will just jump in and say, well, what's the interest rate? What's this? Now, you always want to remind people that closing costs with FHA and conventional, they'll be 2% to 3%. The time of the year can make a big difference too. So property taxes are usually due, and you can just Google this if you forget. It's like November 1st and February, March 1st, something like that is the second installment. But once again, just Google it before you quote someone. So if I'm closing, so any loans I have right now, if we're closing at the end of August, or let's say September, their first payment probably isn't due until November. So it's not like we have time to stock up their escrow account to cover when property taxes are due. So a lender is going to require that they come to closing with the first installment of property taxes. Plus, they're going to, because the next installment is due in March, they're going to have to come with a little extra because we don't have enough months. We don't have 12 months lined up to fill up an escrow account to pay that second installment. So closing costs this time of year might just seem higher, but it doesn't mean it's a bad time to buy. It just, you may have to come to closing a little bit. It can help you with negotiating, which is why, John, it's important to find an agent. And I if it's an agent you've never worked with, just say, but that you want to work with. What I'd say is, this is why I like working with Sally as the agent. She's really good at knowing when we can negotiate and how to negotiate to get you a credit so that you're not coming out of pocket as much. Because right now we are mostly in a buyer's market versus a seller's market. Obviously, there are times where that just doesn't play an effect. Like, you might find just a house is priced really well and fully updated. You may have to compete a little bit, but what we can always do, let the agent and I talk about it and present to you some options on what we think would work. Does that make sense to you guys? Because I had one where the agent calls and they say, hey, they're asking about credits to help cover closing costs. I go, yeah, let's talk about it. Are there any offers? They say 2, but none are over their list price. I go, okay, let's do 6,000 over their list price with a $5,000 credit, because that will give them enough to cover the majority of their closing costs. The rest of it, I can do something called a rate bump. Basically, you increase the interest rate a little bit, gives them some money back. They had brought that up on our first call, so I think they'd be fine with it a little bit. But that way, the seller, we're still $1,000 ahead on their net, right? So it's easier for them to swallow. And that's what we have to then present to the borrower. We have to say, hey, what we're going to do is this, and here's why. We can't just come in and say, you're listed at 500, we're going to offer 505 with a $5,000 credit. Because actually they're netting less than someone that just offered their list price, because real estate agent commissions are a percentage. If you ever have an agent that says, well, I'd be willing to give some of my commission, just go ding, ding, ding. This is a great opportunity to help them earn more of their commission. And I'd say it's very natural for newer people just to immediately go to, I'm going to give up my commission. I'd say, how about we just start with asking the seller first? Because I don't want you giving up. You've earned that commission. Let's just present a case to the listing agent. I'm going to call them and I'm going to say, I'm going to talk up the client and how amazing of a borrower they are. Everything's great. I verified everything. They're not going to get cold feet because I've talked to them about closing costs, down payment, payment. And listing agents do love to hear that. So, makes sense? Yeah. Just to give you, once again, this is why it's great to, you get a loan. Like for you two, it'll be an application gets completed in Blink Plus. You're going to call Charlie or me, depending on what time of day it is, and we're going to help walking you through transferring it over to UWM, which then we can price it out and give them some options. When it comes to giving them a pre-approval letter, I have a pre-approval template that you, and Charlie knows this, that we'll send out because it doesn't mention interest rate, doesn't mention payment. If you do it through UWM, it does mention interest rate and payment, and someone will just take that, give it to another lender, and get a better deal. And you'll lose them, which has happened. So, yeah. Any questions from you two? No? Yeah. So a lot of times, as you're taking those initial client calls, just remember to ask a lot of questions because people will say things that you'll think, okay, I know that they were calling and asking about this, but based on what they just said, I think this is a much better option for them. And it happens all the time. Even loan officers who have very cookie cutter type loan options will refer non-cookie cutter borrowers to us. And I'll say, they'll give me all these details. And I'm like, wait, I don't understand. Why are you trying to do it this way? This has happened recently. We have a new manager, Julie, that finally just got her transfer approved. And this happened recently where it was like there's an equestrian business on the property and then a ADU and basically a second home that is going to be a rental. And I'm like, but it's not a rental right now. They said, no. Okay. Do they need the rental income to qualify? No, they have plenty of income. Do they need the business income from the equestrian business to qualify? Nope. Okay. I don't even understand. Why are we talking about those two things? It should just be there's a house on land with a second house that adds some value. You go, oh yeah. Yeah, you're right. And so, we were able to do a much easier loan and win over the client without overcomplicating it. But some people get just tunnel vision on one thing, and usually the borrowers, sometimes the agents too. So sometimes what they want just doesn't match. You present them options and let them decide, and just tell it to them straight. Give them the options. Let them decide. You'll find so many times people will come around and say, you know what, I was thinking about it and I think I am going to go with your option. I'm going to forget about my whole other business plan type thing.